All right, well, let's go ahead and get started. I know we'll have a few people kind of trickling in as we get going, but welcome everybody. Excited to be with you, and I appreciate you taking a few minutes out of your day to be with us as well. So today we are really focused on kind of key elements to creating a strong foundation to your financial picture. So really my goal for today's conversation is hopefully you can walk away with really 1 to 2 items that you can begin implementing in your own financial life. So just to make quick introductions on who the heck is going to be talking today, my name is Ryan Emerson. So I'm actually the director of our Wealth Builder team here at Curi RMB Capital. I'm based out of Denver, Colorado. I have been in the industry for about 13 years at this point. I joined Curi RMB Capital about 2 years ago, both to create and head up the Wealth Builder offering that we'll talk a little bit more about today. So I'm joined by my colleague, James Roselle. James is a partner and senior retirement plan advisor here at Curi RMB Capital. He's been with the firm for over 12 years, so he's got me beat. And he's been in the industry for well over 25 years. So just some quick things about today's presentation. We are recording, so we will be able to send this to you after. So don't feel like you need to be scribbling notes the whole time. And we will make sure to leave time for questions at the end. So just a little bit about Curi RMB Capital before we dive into kind of the meat of today's presentation. One of the key roles we play here is helping businesses create and offer great retirement plans for their employees. However, we do realize that financial lives are much more complicated than just the plan you have with your current employer. So we have a couple different offerings internally as well. First is the Wealth Builder offering, which is really focused on helping individuals and families with foundational financial planning. We also have our wealth management offering for individuals with slightly more complex needs. So when you think of kind of Curi RMB Capital and who we are, what we do, really we are a comprehensive wealth manager, and we're really able to meet clients where they are today, regardless of what stage they are in their financial journey. So we're working with about 3,200 families across the nation. We manage about $14 billion in assets, which are both great numbers, but really what brings us here today is our core values, specifically speaking to our core value of service commitment. Something we have talked about a long time is seeing how we can help improve financial literacy in the communities that we are already heavily working in. So we plan to do these webinars at least quarterly going forward to bring more information to you. So stay tuned for those invites. Hopefully you can join us not only today, but in the future as well. So brief agenda, we've already done our intros, but we're gonna get right into it. And again, we're going probably an inch deep on a lot of these topics and a mile wide. So we're gonna cover a lot, but we'll make sure to leave time for questions at the end, as well as make ourselves available for follow-up meetings if you have more personal questions that might come up. So quick disclosures, just to make sure our compliance team is happy. Just remember, today is really for informational purposes. There is no legal or accounting advice. But again, we're happy to be a resource for you outside of today's webinar. So why are we here? We realize that one of the most important and one of the most difficult things of getting your financial foundation in place really is just making that decision to start. So we're here today to try and simplify it down so that we can help more people take that first step. The first big item that we always focus on when we're working with individuals is defining your goals. This is something that I believe truly sounds so easy, but it can be very hard to know what the right answer is, to know what your priorities are. So when we think of taking that first step of setting your goals, my first recommendation to you today is to write them down. So once you've written them down, that's when you can start prioritizing. Not everything is going to need to be done today. Many of these goals are going to stretch over short-term, mid-term, long periods of time, which can be 30 plus years. So keep in mind, as you prioritize them, we're looking at all these different time ranges that you see on the screen in front of you. So also, you're not just saving towards one, and then once you complete that, saving towards the next one, you're going to be saving towards many of these at the exact same time. So it's really important to know when you have that extra dollar available, where should it be going? I want to remind you as well that it is okay to have stretch goals. Something that likely is further down the line and further down your priority list, but you need to have those things that you're looking forward to. Good example is my wife and I are really eager to have a place in the mountains here in Colorado. However, for those of you that know Colorado or know real estate in general these days, it is very expensive. So that's way down our list, but hopefully something that if we follow this savings advice, we'll be able to get to at some point in the future. Next one, questions we get all the time is around budgeting and spending. And so now that we have our goals mapped out, I'm not going to tell you that you need to now be saving every single dollar towards those goals. That's unrealistic. But a good frame of reference that we follow is called the 50-30-20 rule. So what does that actually mean? 50%, this is for essentials. Really, you need somewhere to live. You need food. You need to be able to pay your bills. Those are all important parts of continuing to function day to day. The biggest part of this, we always get the question of, how much should I be spending on housing? That's a great question. Our general recommendation when it comes to how much you should be spending on housing is 25% is the target of this overall pie. So nearly half of your essentials going towards housing. We do realize that with today's costs, housing has continued to get more and more expensive. So getting up towards the 30% range is okay. But one thing we want to be aware of is as you cross over that 30% of your after-tax income going towards housing, it can put at risk these other two buckets we're looking at as far as enjoyment and savings. So let's talk about the 30% piece of this pie chart. This is my favorite. You work hard for your money. I think it's important to enjoy your money as well, whether that be travel, dining out, spending time with friends and family. You need to be using your funds to enjoy your life now. I am not the type of advisor that's here to tell you, save every penny so that you can be rich when you retire. You need to enjoy your life today. So last piece here is 20% towards savings and investing. Many of you might be thinking, 20% sounds like way too much. I get it. Life is expensive, but really this 20% is here as a target for you to get as close to as possible, because the closer you can get to 20%, the higher the odds will be of you achieving your financial goals. So keep in mind, when we look at budgeting, it is all a balance. It's not likely going to be 50, 30, 20 every single month. Not realistic. But really what we want to focus on is getting as close to these numbers as possible. So fortunately, there's a lot of tools out there today as far as budgeting. So find something that's going to work for you. We have a fantastic tool that we can give you access to as well that will not only allow you to link accounts to it to help you create a budget, but also start on those foundational financial planning steps. So if you're interested in seeing that, please send me an email after today's conversation, and I'll be happy to get you access to it. Next up is investing. I think it's something that we all are trying to do and putting as much money there as we can. But truthfully, the ups and downs of the stock market can feel quite unsettling, to say the least. I think we are in a time, and just the past week, the past couple of days, this has felt pretty tough for a lot of investors out there. We also know it can be challenging to be thinking 15, 20, 30 years into the future, but it is very important to get started and do your best to stay the course in the investment strategy that's right for you. So one thing that many advisors call the eighth wonder of the world is compound interest. It is about making sure you continue to grow your assets, grow your investments, and take advantage of the gains that you will inevitably get over time. So let's talk about how compound interest actually works. Let's say you invest $100,000 today and you get 5% in year one. Great, you now have $105,000. But where compound interest really gets started is the following years. Let's say you get another 5% in year two. You not only get another $5,000 on that interest you got last year, but you're also getting interest on the interest from last year. So important to continue to take advantage of that. And when we fast forward, if you do nothing else, if you don't save any more towards this bucket, 10 years later, you have nearly $163,000 in there. So important to be taking advantage of that compound interest. And the best way to do it is continuing to be in the market. One item that we're seeing a lot right now is people thinking about going to cash or potentially selling some of their investments. And we just want to caution you that when we look back historically, if you miss the best 10 days over the last 30 years, your returns could have been cut in half. And if we extend that and you miss the best 30 days over that time period, you would have potentially lost an astonishing 83% of your returns. So keep in mind, when we're looking at investing over time, it is that time in the market that can be very valuable to you, and making sure you have the right strategy for you to align with your goals is a critical part of that. So I'm going to turn it over to James just for him to talk a little bit about what types of accounts you should be saving towards and how much you can be putting in those accounts as well.
All right, thank you, Ryan. And nice to see everybody virtually today. So Ryan was talking about something very important, and that's the idea of compounding interest. One of the most important ways to do that or to get that within your retirement or for yourselves is through your retirement account. I know a lot of people on the call today are current participants in 401k plans that we manage, and we've come out and done in-person education. As Ryan mentioned, if you are interested in having a one-on-one consultation, you can connect with us at the end of this call. But what we wanted to focus on right now is just helping you think about some basics as it relates to saving in your corporate retirement account. So 401k plans, 403b plans, if you're a government employee, there's something called a 457, lots of different corporate retirement accounts out there. About 2/3 of Americans have access to a retirement account through their employer. For those who don't, they have to invest in individual retirement accounts. So if you are working and you have a job that offers you a 401k plan, a lot of times they're going to offer you an employer benefit as well. And that's often in the form of an employer match. And so if you put in, say, 6% of your pay, maybe they're going to give you 50% of what you put in. So you're going to get a 3% match from your employer. Studies show that about 75% of Americans take advantage of the match and get all the match that their employers are giving them. But about 25% are leaving money on the table. So if you're not saving enough to get the full match, if you go out today and increase your savings rate, you'll actually get an additional match from your employer, and it'll be like you're getting a raise as well. So if you're not saving up to the match, number one, make sure that you do that. The other thing that we want you to really focus on, as Ryan mentioned, we're in a period right now where there's a lot of volatility. We want you to make sure that you're reviewing your asset allocation and your investments on a regular basis. And we don't want to do it whenever there's market volatility. We want to do it periodically throughout the year. And it might not be good to do it every week or every month. If you're somebody who does not deal well with market volatility, you might want to check in every quarter or every 6 months. But a good rule of thumb is to check in at least annually and ensure that you have the right asset allocation so that if we do have volatility like you're experiencing today, you're able to ride it out like Ryan mentioned, and you're not jumping in and out of the market. The third thing that we want you to think about is Roth contributions. And so Roth contributions are the idea of saving on an after-tax basis. So you go ahead and pay the government taxes today. You put your contributions in after taxes. As a result of doing that, the government is not going to make you pay taxes on the growth. So if you're young, if you're in lower tax brackets today, it's a great idea to be thinking about making Roth contributions so you can pay those lower tax rates today and then know that you're going to have tax-free distributions in retirement where you never have to worry about paying any more taxes. So if you're somebody who really gets concerned about tax rates going up in the future, you may also want to consider making Roth contributions so that you have clarity around, the money that's in your account is yours and you're not going to have to give some of that to the government. All right. So make sure when you're thinking about saving for retirement, again, you're thinking about these 3 items. We also want you to think about maximizing the contributions you put in your retirement accounts. And so the limits are listed below for 401ks, 403bs. You can save up to $23,500 this year. If you are investing in an individual retirement account or an IRA, you can save up to $7,000. And if you're over age 50, because you're getting closer to retirement, the IRS has something available for you called catch-up contributions, where you can save an additional amount, not only in the 401k plan, but also in the IRA account. All right, so make sure you're taking advantage of catch-up if you are over age 50 and you want to save more for retirement. Now, the next thing I want to talk to you about, another really important topic when it comes to saving for the future is related to saving for education. So I know we have a lot of parents on the call today. I'm a parent. I've got twin daughters that are actually 16 years old. That's where all my hair went. My kids are actually going to be entering college in a couple of years. So I've been really focused over the last 10 years or so of saving in something called a 529 college savings plan. And so this is a great way for you to save for your for your children or for yourself or other dependents for college, basically. Some states will allow you to use these dollars to pay for tuition for K through 12 education, but not all of them do. So if you're thinking about saving in a 529 for something other than college, make sure that you understand the rules for your state where you live. There are also a couple of other accounts listed here. A Coverdell Education Savings Account is another way to save. You can do that for college. You can also do that for K through 12 education. Those accounts give you a little bit more flexibility in regards to how you can use the dollars. So if you are looking for more flexibility, you might want to consider a Coverdell account. You also have some different options when it comes to investing with a Coverdell account than you do with a 529. So you might want to look into that if you're looking for more diversification or flexibility when it comes to the investment choices. And then the third option that we have here is what we call an UGMA or an UTMA. We use a lot of really ugly acronyms in the retirement industry. Those are two of them. Those are basically accounts where if you're trying to save for your kids and they're minors today, you can basically open up an account, kind of like a brokerage account where they can go out and start investing. If you have kids that are in college, or that are have jobs over the summer and they're earning money, that's a great way for them to actually put some money into an account and start learning about investing. All right, I'm going to pass it back over to Ryan now to provide some more details on how to build a strong financial foundation.
Perfect. Thank you, James. All incredibly important. And just to reiterate the point, as far as getting a checkup, I think when you look at your employer plan, it's important to make sure the allocation aligns in there with your goals going forward. But we know conditions are going to change over time. We know some investments are going to become overweighted, underweighted. The news cycle is constant. And we really want to make sure that that's not the guiding principle of your investment strategy. We also are aware that goals, your priorities can change and will change. So you need to get that checkup to make sure that your investments align with those changes. So just like going to the doctor annually, James and I do not have fancy white coats like this woman does, but you're going to have concerns that come up throughout the year, and you need to be taking a look at kind of where things stand today and if they are appropriately aligned with your goals going forward. So last big slide for today's conversation is, what else should you be thinking about? There's a lot of pieces impacting a sound financial plan. So the biggest one, in my opinion, is taxes. It is important to know what you're buying. Which account are you putting it in? What's a good time to sell it? Tax planning truly is a year-round process. It's not something that should be thought about in March or in April, for those of you that might be waiting a little longer to file your taxes. So you need to be thinking about it throughout the year so that come tax filing, you are in a more efficient place. To hit on some more acronyms, there's a lot of more accounts out there. There's HSAs, that's health savings accounts, IRAs, James mentioned those, the individual retirement accounts. Again, sorry for the use of so many acronyms in the financial services industry. We also want to be thinking about charitable giving. Many of our clients that we work with, where possible, are charitably inclined. Is it always best to do cash? Maybe not. Maybe we should be looking at appreciated securities, where you get a better tax or get a tax write-off that's going to allow for you to reduce what you show in taxable income for that year without having to pay taxes first. Insurance, also important as well. Do you have children or people that depend on you? Is what you have enough? Most people we find are pretty underinsured, which can be concerning, and it's something that usually can be easily addressed. But there's also a lot of life insurance policies out there that are incredibly costly and maybe not giving you the coverage you're actually looking for. So this is not a one-size-fits-all solution. So we also know that many of the individuals we work with that are still working may have some life insurance through work. The things you need to be thinking about there is, it's great while you're employed, but that might not follow you if you leave. So looking externally, looking for policies that meet and align with your long-term goals to make sure you and your dependents are taken care of is very important as well. So last piece on here is estate planning. we really want to make sure that if something were to happen, that your will, that your wishes are executed appropriately. So do not let your assets go into probates or let your heirs fight about what to do with your money. Make sure you have a sound estate plan in place so that there is clarity for everyone. So just a note here, we do not file taxes. We do not sell insurance. We are not drafting up estate documents for our clients. We are a fiduciary to our client base, meaning that we don't sell those products. However, we understand how important it is to make sure that those are tied in and coordinated with your overall financial plan so that you are in the best situation possible. So that's really what we've prepared for you today. We want to just take a minute to say thank you for listening. We know that, again, we went a mile wide on a lot of these topics, didn't give too much detail, but they're all important things that you should be thinking about as you think of your financial picture, both today and in the future. So we're going to open it up to questions. On the next page, I'm actually going to show our contact information as well as our QR codes, so you can get direct access to our calendars as well. So happy to meet with you, address what's top of mind for you, give you that checkup that we've both talked about if that is of interest to you at this point. But again, thank you for taking some time, and we'll turn it over to Belinda Ryan, our colleague, who is going to voice some questions. So you'll see at the bottom of your screen that you can enter a question. We'll do our best to get to as many as we can over the next 8 minutes while we still have you. But thank you all.
Thanks, Ryan. We do have some questions coming through. If anyone has any questions, you can feel free to send them into the Q&A box. I will read them aloud so they'll remain anonymous. If you have more detailed questions, again, like Ryan was saying, please feel free to reach out to either Ryan or James and they can spend some more time with you. Our first question is, can a grandparent open up a 529 or is it only for parents and guardians?
Yeah, good question.
So James, grandparents can open 529. So 529s can be contributed not only by the parents, but also grandparents, siblings, nieces, nephews. So basically, you can contribute to other people's 529s if you'd like to.
Thank you. My next question is for Ryan. I have heard that 6 months of expenses is good for an emergency fund. Is that still what you recommend?
Yeah, so we're going to recommend 4 to 6 months in that emergency savings vehicle. And one important part when you think about those cash funds as well is making sure that you're in a high yield cash account. We encounter too many situations where emergency funds are sitting in savings or checking account that's getting 0.05% interest. Really, with where rates are today, you should be getting at least 3 to 4% on those emergency cash holdings.
Thank you. My next question is also for Ryan. You mentioned that many people are underinsured for life insurance. What is a good metric to help calculate appropriate insurance?
Yeah, great questions. And one thing I always look at when it comes to life insurance, again, it's different for everybody's, but we're going to look at kind of your current financial base. How much money do you have saved up? Your needs mostly focus on if you have dependents, making sure that if something were to happen to you today, that you are going to be able to cover expenses for their life. You realize those expenses might vary if you want to cover college or pay off a mortgage. If something were to happen to you, that's going to increase how much life insurance coverage you need. So those are some of the factors that we're looking at when it comes to how much life insurance coverage you need. Again, that's going to differ from person to person.
Thank you. James, this question is for you. Why would you want to pay into a Roth? It sounds like I would be paying taxes twice.
No, so actually with a Roth, you pay the taxes once when you make the contributions, and then you get to take the contributions out tax-free because you've already been taxed, and then you get to take the earnings out tax-free, which it will never be taxed. So you're only paying tax initially. And again, you have to keep these accounts in as a retirement account and use them in retirement. You can't take them out before age 59.
Thank you. James, this one is also for you. Can you discuss the conversion of a traditional IRA to Roth as one gets closer to retirement?
Yes. So not just with IRAs, but also within your 401k plan, you have the option to do what's called an in-plan conversion. So that's the idea of taking some of your pre-tax money today and pretending as if you've taken a distribution. So you're going to get a tax form that's going to show that you took that money out of the plan at tax time. You actually do not get any money from your account. And then you're required to pay the taxes when you file your tax return. So let's just assume that you took $10,000 out and you converted it in 2025. And let's assume you were in a 25% tax bracket. In 2026, you're going to get a tax form that's going to show that you owe $2,500 in taxes to the IRS. And then that's essentially you paying for the conversion. Once you do the conversion, then all the money within your account gets converted to Roth, and then any earnings from that point forward are no longer taxable.
Well, and only other comment I would add there is that Roth conversions are heavily talked about today. They're not always appropriate for everybody. So make sure to consult somebody if it makes sense, given your tax situation today and potentially in the future, if it does make sense for you to do a Roth conversion.
Right. And when you convert money, you're adding money to whatever income you earned for the year. So remember, you're converting at the top of your tax brackets, basically. So that's what Ryan's referring to there.
Thank you. Ryan, this one is for you. Can 529s, if unused, be transferred to another person, family or non-family member tax-free?
So there are a few restrictions around them. You can transfer them to family. Oftentimes we see that from one sibling going to another sibling. There's no tax implications of that. However, this is a common concern I hear with 529 plans is, what if my kids or whoever I'm contributing for doesn't use it? So with the Secure 2.0 Act that passed, losing track of time, is either last year or the year before, there are some opportunities to actually convert up to $35,000 of unused 529 funds to a Roth IRA for that dependent. So I see this as a great kind of kickstart to their retirement savings without necessarily leaving funds behind that could incur any type of penalty.
Thank you. James, this one will probably be for you, but Ryan, feel free to add if you have anything additional. If I have a traditional 401k, when I take money out at retirement, how do I figure out the taxes I would pay, for example, and what tax bracket I might be in?
Yeah, so when you take money from a retirement account, like a 401k account, it's treated as ordinary income. So it's no different than if you're getting paid from a job. So when you get paid from a job, they run you through the tax brackets. And as an example, if you're married filing jointly, the first bracket, 10%, I think you pay up to like $25,000. And so the whole idea here, again, is that you're going to run through the tax brackets based on the amount of income that you're taking out from your 401k plan. So the less you take out, the lower taxes you're going to pay. And that's what we want you to think about, is how you can manage to take money out and stay in those lower brackets so you're not getting into those higher rates.
Thank you. One more question. Let's see. When you talk about, Ryan, this one's for you. When you talk about saving for goals, such as short-term goals, where should we be putting the money that we're saving for? Just a savings account?
Yeah, good question. And somewhat similar to my answer before is that you should be looking at high yield savings accounts. So there's plenty of options out there. We use one for our clients that offers 4% today. You want to make sure you're getting some interest, even when you know that you're going to be using those funds within the next year or two. So don't let it just sit in a checking account waiting to be spent. You might as well be getting some interest on it in the meantime. So we're always hesitant to invest it when there's that short of a time horizon, especially in stocks. But we want to make sure that you have a high yield cash account where you can be generating some interest before that expense occurs.
Thank you. We have time for, I think, one more question. Ryan, this one will be for you. Any projections or thoughts on where housing interest rates will head in the short term?
Yeah, that's a good one. I think when we look at today's marketplace, it's incredibly hard to tell. And that's something that if somebody can tell you they know or can predict exactly where things are headed, be very cautious of that. The fact is, when we look at what's happening in today's market with tariffs and other economic impacts that we are seeing, tariffs can be an inflationary event, which if we see inflation go up, we are likely not going to see interest rates going down anytime soon. So things we want to be kind of looking at in today's marketplace is interest rates may stay higher for longer, but we cannot predict if they're going to go up or down tomorrow, along with the next person can't predict
Thank you. So we're at the top of our 30 minutes. We still have a few questions. If people want to reach out to Ryan or James with those questions specifically, they would be happy to take some time and answer those.
Perfect. Well, thank you, Belinda. Thank you, everybody, for the questions, and really appreciate you joining us here on your Tuesday morning or Tuesday afternoon. Again, please reach out with any questions. I'm going to pop our QR codes back up on the screen for just one more minute. But have a great rest of your week, and thank you again for your time.